Okay, let's dive right into this explainer. Today, we're investigating the underlying health of Palomar Holdings, and we're using their fascinating Q1 2026 earnings report as our primary evidence. Now, if you follow the insurance sector, it can sometimes feel like a slow-moving giant. But Palomar, they're doing something fundamentally different. Their latest quarterly filing reads less like a standard, dry corporate update and honestly a bit more like a financial detective story. So we're going to unpack exactly how they're engineering this massive growth, where the hidden risks might be lurking, and why their management team is acting so aggressively with their cash pile. Right out of the gate, we have to talk about this number, a 42.4% surge in gross written premium. That means they brought in nearly $630 million to kick off the year. Look, in the world of specialty insurance, growing your top line by over 40% in a single quarter is literally staggering. It sets the entire stage for everything we're about to look at today. But to truly grasp how on earth they achieved this, we got to look under the hood. Section 1. Meet Palomar Holdings, the one-of-one insurer. So the secret here is that they aren't trying to be all things to all people. To really understand those explosive premium numbers, you have to realize that Palomar operates entirely differently from your traditional old-school insurance company. They leverage proprietary data analytics to surgically target very specific, underserved markets. Like CEO Mac Armstrong says, they view themselves as a one-of-one specialty insurer. By blending admitted and excess and surplus lines together, they've built this portfolio that's designed to be bulletproof, or, at the very least, highly resistant to the usual violent swings of the broader property and casualty market cycle. They are purposely engineering consistency. Section 2, Q1 2026, by the numbers. Let's see exactly how that bulletproof strategy translated into cold hard cash this quarter. Because, having a brilliant strategy is one thing, but execution is what actually pays the bills. Palomar's top-line revenue expanded from roughly $442 million last year to almost $630 million today. This wasn't just a slight earnings beat. No, this was a fundamental scale-up of their entire operation. But as any seasoned investor will tell you, top-line revenue is only half the story. We need to know what actually trickled down to the bottom line. And here is where it gets really interesting. It's crucial to balance these two realities. Their raw, unadjusted net income stayed totally flat at $42.9 million. But their adjusted net income, which is the metric that measures core profitability, leapt 23% to $63.1 million. So why the huge gap? Well, that flat, unadjusted number includes some really heavy lifting they did this quarter. Things like integrating a recent acquisition, Palomar Casualty and Surety Company, and navigating some strategic shifts in their business mix. But that 23% jump in the adjusted column, that tells us the underlying economic engine is just humming beautifully. Section 3, Beyond Earthquakes, Driving Broad-Based Growth. Now, you might actually know Palomar for earthquake insurance. That's definitely where they made their name, especially in places like California. But today, they operate across 5 distinct pillars: earthquake, inland marine and property, casualty, crop, and surety and credit. What's super impressive here is that 90% of their premiums now come from lines that aren't exposed to the typical property and casualty cycle. They've systematically diversified away from being just an earthquake player, turning themselves into this well-rounded specialty powerhouse. If one segment slows down, the others are there to pick up the slack. And right now, the crop and surety divisions are absolute rocket ships. It's proof positive that their big bets on off-cycle products are paying massive dividends. Crop premiums spiked 82% year over year. That was heavily driven by strong winter wheat production and a specialized underwriting team they brought on last year. Meanwhile, surety and credit skyrocketed an unbelievable 131%. They even secured a special federal delisting authority to expand their bond writing. Momentum is so strong that Palomar actually just raised their full-year crop growth target from 30% to 35%. Section 4, Navigating Risks and Ratios, Unpacking the Catch. Okay, let's take a breath, because explosive premium growth usually comes with extra costs and hidden risks. Growth is amazing, but if you're buying bad risk just to get bigger, it is absolutely going to catch up with you. Before we grade their performance, let's quickly touch on the combined ratio. This is essentially the ultimate lie detector test for an insurance company's profitability. Simply put, if this number is under 100%, the core insurance business is making money before their investments are even factored in. The lower the number, the better the margins. So Palomar's unadjusted combined ratio ticked up to 84.5%, up from 73.1% last year. Now, why the increase? It's primarily because growing those casualty and crop segments so fast temporarily shifted their expense mix. It just costs money to rapidly scale new lines of business. However, and this is the key takeaway, they are still well below that critical 100% threshold. They're generating solid underwriting income, over $40 million this quarter alone. The other vital metric we need to track is the catastrophe loss ratio. This tells us if sudden, unexpected disasters are eating into their carefully managed reserves. For a company that still writes a lot of earthquake and hurricane policies, one really bad weather event can absolutely ruin a quarter. But astonishingly, their catastrophe loss ratio for the quarter was a microscopic 0.1%. 0.1! They effectively tiptoed right through the raindrops this quarter, completely avoiding major disaster payouts. This incredibly low ratio is a testament to both a bit of good fortune and their heavily reinsured, hyper-disciplined underwriting model. And to keep their balance sheet completely bulletproof as they expand, they are intentionally over-reserving cash for their new casualty lines. They are holding cash well above industry norms. Over 80% of their casualty reserves are categorized as IBNR, which stands for incurred but not reported. During the earnings call, management stressed that they start their new business lines with nearly 100% IBNR. Basically, they're purposely hoarding a massive safety net rather than artificially inflating today's profits. That is exactly the kind of prudence you want to see from a management team guiding hypergrowth. Section 5. The $200 million buyback strategy. Deploying the capital. So, now that we know the core business is highly profitable and defensively positioned, let's explore how management is actually rewarding its shareholders. With an annualized return on equity consistently hovering over 20%, cash is piling up fast, and that leads us to a critical question. Why authorize $200 million to buy back their own stock through May 2028? For some context here, Palomar's total market cap is around $3 billion, so a $200 million buyback is a very meaningful chunk of the entire company. Well, management isn't being shy about their reasoning at all. They firmly believe the broader market is undervaluing their 30% earnings growth rate. Think about it. When you're growing your bottom line at a compound annual growth rate of over 30% since 2023, and your stock price doesn't fully reflect that upward trajectory, buying back your own shares becomes one of the single most accretive things you can do with your capital. And they are absolutely putting their money where their mouth is. They repurchased over 190,000 shares for $23.1 million in the first quarter alone. And remember, that was before this new, expanded $200 million program was even officially approved in May. They are aggressively scooping up their own equity. Section 6, 2026 Outlook and Analyst Take. Looking ahead? So how does all this build into their financial roadmap for the rest of 2026? And what does Wall Street think about it? Well, they just raised their full-year guidance for the 8th time since 2024. They're forecasting up to $278 million in adjusted net income while explicitly baking in estimated disaster losses. By pre-baking $8 to $12 million of catastrophe losses directly into their guidance, they are managing market expectations beautifully. Even if a moderate disaster strikes, they're signaling to everyone that their profitability targets are going to remain completely intact. Of course, it wasn't all just cheering on the earnings call. During the Q&A, analysts really grilled them on drought risks. An analyst brought up highly legitimate concerns about bad weather and fertilizer inflation impacting that booming crop insurance segment we talked about earlier. But Palomar's executives immediately parried the question. They explained that their risk transfer structures, which is basically insurance for the insurance company, absorb the shock of those specific environmental variables. Bottom line, Palomar's yield stays protected. So, as we wrap up this explainer, the lingering question is whether Palomar's unique structural advantages and rock-solid balance sheet align with your own personal investment strategy. We've seen how they leverage data to isolate incredibly profitable niches. We've seen how they aggressively over-reserve cash to protect against downside surprises. And we've seen how they aren't afraid to step right in and buy their own stock when they sense a dislocation in value. Are they truly a one-of-one business, or just a really well-run insurer enjoying a highly favorable cycle? Well, that's the puzzle for you to solve next. Thanks so much for diving into the numbers with me today.